Good morning, afternoon, evening, whenever you're watching this. My name is George Bishay. I'm the head of credit sustainable strategies in the Pendal fixed income team. In this update, I'll spend a few minutes talking about what drove markets last month. Then I'll give you a short update on a new ESG bond that we bought during the month. Importantly, this update is general information only and does not represent financial advice. I'll start with market movements. So you can see here on the slide, uh, just here we've got equity markets. The ASX was up 3.2% for the month. S&P down 90 basis points. 10-year bond yields in Australia, we were down 16 basis points in yield, and in the US we were down 30 basis points in yield. Importantly, the total return of the Australian bond benchmark was up 88 basis points. So what drove markets over the month? Markets dealt with a number of headwinds during the month. The first is AI disruption concerns. So Anthropic, so that's an American AI research business, it announced a new automation tool. So the tool itself basically automates tasks across legal, marketing, and data analysis. It raised concerns that AI may replace core software and a major concern for software businesses. And those types of stocks got absolutely smashed last month. The second headwind was around private credit. So concerns surfaced when Blue Owl Capital, that's a US private credit fund manager, permanently halted redemptions on one of its private credit funds that had quite a significant exposure to technology sector. This highlights the major risks around private credit, which is transparency and liquidity. Private credit managers as a cohort saw their share prices get absolutely hammered last month on the back of these risks. The third headwind was geopolitical risks. So Iran's nuclear program was in focus. We ultimately saw the US and Israel fire airstrikes on Iran the weekend just passed. And this saw oil prices jump quite sharply on the open. On the positive side, US and Australian companies' earnings, the earnings reports, were actually better than expected. In the US, three quarters of companies beat earnings expectations by 6% on average, and the actual growth rate was about 12% for the quarter, PCP. And in Australia, 68% of companies beat or met expectations. On average, those earnings beats were about 11% beat, with actual growth rates of 14% half on the half, and that was compared to the prior corresponding period. On the economic data front, in the US, economic data was mixed. Soft retail sales, lower than expected CPI, and employment cost index all offset stronger payrolls. And in Australia, economic data was generally stronger than expected. So, specifically, the employment data and monthly CPI were better than expected. And then we also had the RBA raise cash rates by 25 basis points. This was mostly priced in on the back of inflation pressures. So I might just now share one of my Bloomberg charts. Now, this chart here, I'll just explain it. The green line is Australia and the blue line is the US. And what it's showing you is what the market expects the cash rate to be in both Australia and the US by the end of 2026, by the end of this year. And it shows you over time what's happened. So this chart's a 6 months chart, and you can see 6 months ago both markets were expecting roughly a 3% cash rate in Australia and the US by the end of 26. Now you can see the blue line here has pretty much stayed that way. So let's call it markets still expecting a 3% cash rate in the US by the end of the year, whereas in Australia, things changed a lot. We moved from pricing in rate cuts to now to pricing in rate hikes, and we have seen the RBA raise rates. So you can see that in Australia, those expectations changed by 1% higher over a 6 month period. So what drove that? It's basically all around the difference in the economic data in Australia and the US. In Australia, notably, we've had stronger than expected inflation come through, and we've also had stronger employment numbers come through. Whilst in the US, it's generally been within expectations. So that's been the main divergent. So in Australia right now, we've got 35 basis points of hikes priced in. And in the US, if you go out a bit further, they have three 25-point cuts priced in. So call it 75 points of cuts priced in. Main difference there being economic data in Australia has been stronger relative to the US. Let's move on now to an ESG bond that we invested in during the month. It was a bond issued by one of the major banks. It's ANZ Bank. It's called the ANZ Sustainable Development Goals Subordinated Bond. Bit of a mouthful. It's got a 6-year call date, and its credit rating is A minus. So the bond finances a range of projects. Approximately 80% of those projects are for environmental activities and 20% to social activities. Examples of some of the underlying projects of this bond that it's funding. On the environmental side, it includes wind, solar, and battery storage projects. And on the social side, it's funding projects like social housing, aged care, and financial education programs. The great thing about these types of bonds is that allow investors to support climate stability and social outcomes while also having exposure to high credit quality issuers. And also the credit spread for this bond's quite appealing for its credit rating and maturity profile. Thank you for your time. Please reach out to our distribution team if you have any questions or you'd like more information on the portfolios.